Welcome to Thoughts on the Market. I'm Jonathan Garner, Morgan Stanley's Chief Asia Equity Strategist. Today I'll discuss why we remain positive on India's long-term equity story. It's Tuesday, the 24th of June, at 9 a.m. in Singapore. We've had a long-standing bullish outlook on the Indian economy and its stock market. In the last 5 years, MSCI India has delivered a total return in US dollars of 145%, versus 94% for global equities and just 39% for emerging markets. Indian equities are our most preferred market within Asia for three key reasons. First, India's superior economic and earnings growth. Second, lower exposure to trade tariffs. And third, a strong domestic investor base. And all of this adds up to structural outperformance, not just in Asia, but indeed globally, and with significantly lower volatility than peer group markets. So let's dive deeper. To start with, the macroeconomic backdrop. We expect India to account for 20% of overall incremental global GDP growth in the coming decade. Manufacturing competitiveness is improving thanks to bolstered infrastructure in power, ports, roads, freight transport systems, as well as investment in social infrastructure such as water, sewerage, and hospitals. Additionally, India's growing middle class offers market opportunities to companies across many product categories. There's robust domestic consumption, a strong investment cycle led by public and private capital expenditure, and continuing structural reforms, including in the legal sphere. GDP growth in the first quarter was more than 7%, and our team expects over 6% in the medium term, which would be by far the highest of the major economies. Furthermore, we continue to expect robust corporate earnings growth. Since the end of COVID, MSCI India has delivered around 12% per annum dollar earnings per share growth versus low single digits for emerging markets overall, and we forecast 14% and 16% over the next 2 fiscal years. Growth drivers in the short term include an emerging private capex cycle, re-leveraging of corporate balance sheets, and a structural rise in discretionary consumption, signalling increased business and consumer confidence after last year's elections. Another key reason that we're positive on India currently is its lower than average vulnerability to ongoing trade and tariff disputes between the US and its trade partners. Exports of goods to the US amount to only 2% of India's GDP, versus, for example, 10% in Thailand or 14% in Taiwan. And India's total goods exports are only around 12% of GDP. Moreover, for the time being, India's very large services sector's exports are not exposed to tariff actions and are actually early beneficiaries of AI adoption. Finally, India's strong individual stock ownership means that there's persistent retail buying, which underpins the equity market. Systematic investment plan flows, driven by a young, urbanizing population, are making new highs, and in May amounted to over $3 billion US. They provide consistent capital inflows, and means that the domestic bid on stocks is unlikely to fade anytime soon. This provides a strong foundation for the market and supports valuations, which are slightly above emerging market averages. It also means that its market beta to global equities are low and falling, approximately 0.4 versus 1.1 10 years ago, and price volatility is well below other major emerging markets, all told making India an attractive play in volatile times. Thanks for listening. If you enjoyed the show, please leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.